Welcome to The Explainer. Today, we're taking a calm, structured look at a massive financial crossroads. It's a journey that almost everyone who takes their personal finances seriously has to face at some point, right? We're talking about that daunting leap from safe, predictable savings to the vast and, sometimes intimidating world of the stock market. So we're going to decode exactly how to navigate this using real-world insights and expert analysis. Okay, let's dive right in. So this whole explainer was actually sparked by this incredibly relatable dilemma I saw on the r/Singapore FI subreddit. It says, uni student here with 25K in FD 3.22% and 9K T-bills 3.66%. Should I start looking at stocks and trading? We've got a university student who's diligently parked $25,000 in fixed deposits and another $9,000 in treasury bills. Honestly, they're getting decent, safe yields of around 3-ish%. But they've hit a wall. They've realized that while these vehicles are incredibly safe, they simply aren't going to compound fast enough to build serious, long-term wealth.
The crucial point here is that sitting on $34,000 in cash equivalents at age 25, that is a fantastic safety net. It's an incredible achievement. But naturally, there's this itch to outgrow those safe, traditional Singapore savings vehicles. The big question is, what actually comes next? Do you invest or do you trade? And honestly, more importantly, do you actually know the difference between the two?
Section 1. The Great Wealth Divide.
Drawing on some awesome insights from the financial channel The Plain Bagel, there is just a stark contrast between these two approaches. When we talk about investing, we're really talking about a long-term horizon. You're relying on the gradual, underlying growth of an asset over years or even decades. Think of it as a steady, patient climb. Trading, on the other hand, fast and furious. It operates on a super short-term time frame, sometimes weeks, sometimes days, sometimes literally seconds. A trader relies entirely on market volatility and quick price swings to make a profit.
And because of that incredibly short time frame, trading is a uniquely high-risk arena. Everyday retail players, regular folks sitting at home, are actually up against seasoned industry professionals and lightning-fast algorithms. You're forced to act on fragmented information. Plus, because the profit margins on individual trades are often tiny, it demands this exhausting, continuous cycle of opening and closing new positions. As the Plain Bagel points out, it's highly comparable to playing poker. You might be good, but there's a lot of chance involved, and if you're sitting at a table with institutional whales, the odds are fundamentally stacked against you.
Section 2. Intrinsic Value versus Price Action.
So if the timelines for trading and investing are just so totally different, how do these two camps actually evaluate what a stock is worth? Well, let's pause for a second to really let this concept breathe. Intrinsic value. Basically, this is the true underlying worth of a stock based on a company's actual fundamentals, their assets, their profits, their overall growth potential. Now, the market price you see flashing on your screen on any given Tuesday, that might be way higher or lower than this intrinsic value, usually driven by human emotions like fear or greed. But the idea is that over the long haul, a stock's price should fundamentally track back to its intrinsic value.
Check this out. It's fascinating how different market participants react entirely differently to the exact same set of information. A passive investor just ignores the noise, focusing purely on long-term growth to benefit from the overall aggregate rise of the market. An active investor tries to calculate that intrinsic value we just talked about, looking to scoop up undervalued stocks and hold on to them until the market corrects itself. But the trader? They focus entirely on technical indicators, the historical charts, the momentum, with the sole goal of exploiting short-term price trends.
And that brings us to a huge takeaway. Traders honestly just care about the stock's price. A day trader might buy and sell thousands of shares of a company without even knowing what product that company actually makes. Seriously, their entire analysis is based on historical price charts, human psychology, and technical trends. They aren't buying a piece of a business, they are just trading a symbol.
Section 3. The BTO Portfolio Wipeout.
Now, let's bring this theoretical discussion back to reality here in Singapore. For young adults, pure financial theory eventually collides head-on with inevitable life milestones. I absolutely love this quote from the Reddit thread because it perfectly captures the local experience. Quote, BTO gonna reset your portfolio like the Great Flood. It builds instant empathy because, honestly, it's just so true. For a 25-year-old, the reality is that most early investment portfolios are destined to be liquidated anyway. You're going to need that cash for your built-to-order HDB flat, for a wedding, for renovations, the whole shebang.
Because of that very real timeline, the community actually offers a really pragmatic perspective on risk. Losing a chunk of your savings at 25 while experimenting with trading, it isn't seen as a total failure, it's widely considered a valuable tuition fee. It gives you those necessary emotional scars that teach you how to handle market panic and truly understand your own risk tolerance. Losing your life savings at 45, however, is a totally devastating setback to your retirement. The big lesson here is that youth affords you the luxury of making mistakes.
Section 4. Your next financial steps.
So how do we synthesize all of this into something you can actually use? Well, here is a totally grounded, actionable roadmap taken from the absolute best advice in our sources for safely deploying capital without blowing up that hard-earned safety net. Step 1. Anchor your wealth. Build a core portfolio with broad passive index funds like the S&P 500 or VWRA. This is going to provide your long-term stability. Step 2. If you really want to trade, practice first. Use a paper trading account to test your strategies with fake money before you risk your real capital. And step 3. If you absolutely must scratch that trading itch with real money, quarantine the risk. Allocate a strict maximum of 10% of your funds for active play trading.
To wrap up the mechanics, I want to walk you through these golden rules of risk management, shared by a 25-year market veteran in the thread. First, invest in your own financial literacy before absolutely anything else. Second, protect your capital ruthlessly. Never risk more than 1% of your total capital on a single speculative trade. Third, the sleep test. If you're lying awake at night worrying about a position, you have definitely taken on too much risk. And finally, the ultimate rule of investing. Time in the market consistently beats trying to time the market.
As we close out this explainer, I want you to reflect deeply on your own motivations for wanting to jump into the market. So I'll leave you with this. If you lost 50% of your play money tomorrow, would you be more upset about the cash or what you failed to learn from the process? Keep that in mind as you map out your financial future. Thanks for joining me on this explainer.